Welcome back, friends. So, Nvidia has reported stellar earnings on Thursday, and that propelled the Dow, S&P, Nasdaq to rise, and it has, especially the Nasdaq, rose very sharply on the back of superb results from Nvidia. The company holds a rather strong position in the fast-growing AI market, but I believe that there are some potential problems which can go and disturb the rally going forward, including competition, oversupply, and some regulatory concerns. There is probably very few people around you who would um, tend to agree with me at this point of time. But the purpose of this video is to try and spell out a few of the reasons why I think so. Despite its enormous success, Nvidia's stock may already be nearing a short term top, and AI revenues could be expected to slow down, impacting its valuation multiples. Ultimately, it is possible that although there are more bulls than bears, but both bulls and bears could be right over the long term. The very close analogy that I can draw is the dot-com boom, and we had companies like Cisco going through the roof. In fact, if you go and plot the graphs of and the price movements of Cisco and Nvidia, they begin to appear similar in many respects. Let me go a little bit into the depth and explain, and I'll try to be as brief as I can. Now, the company has managed to uh, exceed even the lofty expectations of Wall Street over the last 2 years. And there are so many factors to be bullish about it. But what I can tell you is that whereas AI is here to stay, artificial intelligence will only keep on increasing over the months and years ahead. The Nvidia stock itself could run into rough weather over the short to medium term. So let me just go briefly over the guidance. Last quarter made it clear to all investors what was going to happen at this earnings, but the company, although has surpassed expectations, revenues have grown to the tune of 126% year on year, and the gross margins have expanded to 72.7%. This is, of course, nothing short of remarkable. The company has more than doubled its revenues while the operating income has remained mostly flat. This is as per the 10K filings. Now, the bulk of the rise in the revenues by the reportable segments as per the US GAAP shows that the increase has come mostly in the compute and networking segment, which has grown by 215%. Unlike what most people may believe, the graphics revenue has changed only 14%. So that's not what many people would. But if you go and take a deeper dig inside, you can get to know more what's going on. And as you can see, the 72.7% gross margin translates into a very handsome 54% operating margin and a 48.9% net income margin. Now, what's the guidance for the coming quarter? $24 billion in revenues, plus or minus 2%, non-GAAP operating margins at 77%, and a third is the mid-70s margins for the remainder of the year. Now, this quarter revenues came in at roughly $22.1 billion, up 22% sequentially. And now the company expects roughly 10% growth for the next quarter. Okay, now that 10% growth means some signs of a slowdown. So despite an absolute monster year, the growth expected to slow down going forward. Nonetheless, demand for NVIDIA's GPUs will continue to grow at a healthy clip. For anyone who still doesn't understand why the NVIDIA's GPUs have become so much sought after, you must go to the highlights of Jensen's last earnings call highlights, okay, given to the analysts. Now, following the latest earnings, some have actually argued that despite significant stock appreciation, stock is cheaper than before. There is that school of thought as well. NVIDIA's forward price earnings currently sits at 31, which is actually not that far from Apple's 28 and actually lower than Microsoft's 34. Furthermore, the stock is actually pretty well priced if you look at the PEG and forward PEG, both of which are below 1. However, the stock is very expensive even compared to its lofty, magnificent peers, if I may call them. For example, by looking at the EV to EBITDA of 74 or the price to book of over 50. For reference, Apple has an EV to EBITDA of under 21 and a price to book of 38. So NVIDIA's is at 74 and 50 respectively. So there's an argument here to be made that NVIDIA is only as expensive, at least in some metrics, as its peers. Arguably, it is well worth a premium given that the company has doubled its revenues. Okay, so I would say that yes, there could be an argument that both the bulls and the bears are right. The AI revolution is indeed here to stay. There's nothing to doubt about that. Investors can, however, go back to the dot-com era and compare it to the dot-com crash. But in order for doing that, we need to look at some, or rather add some nuance. A lot of stocks crashed in 1999. Some never recovered and others became the largest e-commerce platforms in the world. We have companies like Pets.com. In 1999, Pets.com made $619,000 in revenue and spent $11.8 million in advertising. This was a company with no earnings, trading at an insane valuation. However, NVIDIA does possess many similarities to arguably the largest winner of the 1990s internet hype, which is Cisco Systems. Cisco traded at $80 on March 27, 2000, became the world's largest company and traded at a price-earnings ratio of 220. It was the time of the new age of the internet, and Cisco's